Evan, they're flagging IMF growth forecasts. OECD got us in its sights as well.
Yeah, that's right. They've cut the Australian GDP growth expectations for 2013 to 2.6%. They've actually cut this for the third time now. 6 months ago it was up around 3%. A year ago they were expecting around 3.7%. I think there's a couple of key points that we heard from the OECD. One is that they're expecting mining investment to peak this year in 2013, and that's going to have a slowing effect in terms of growth. And also the other point was that new non-mining investment is taking some time to gain traction within the economy. You know, we saw the IMF downgrade growth to China last night. That's putting pressure on Australia's terms of trades in terms of lower commodity prices. It probably adds further weight to the argument that the Reserve Bank needs to cut rates further, and of course puts further pressure on these capex numbers today, where around 0.5% is expected for the first quarter. And while the mining capex numbers are important, of course, because that has been a big driver of Australia's terms of trade, I think the RBA will certainly be focusing on the non-mining sector of the economy and business investment expectations and actual investments within that side of the economy as well, because that has been very clear from the Reserve Bank that they've been cutting rates to try and boost the domestic non-mining sector of the economy. They know, the RBA, that there's already been something like $120 billion in new projects cancelled or suspended by the big miners over the past 12 months, and non-mining business investment has remained soft. I mean, you've seen it in the credit figures. Business credit growth has continued to slow over the past 12 months. And you know, the Reserve Bank now, of course, has the 200 basis points of cuts really gained traction within that non-mining sector of the economy. So I think that's why those particular figures within the release today will be important. The OECD, they're a bit more positive in the long run. If you look at their forecast for 2014, they're expecting a pickup there to over 3% of GDP growth as the non-mining investment part of the economy starts to accelerate.
Later, because it was actually a star performer yesterday. But let's go to Seven West Media with you, Tim, I think. Don Voelte might actually get a bit of a tap on the shoulder to replace Peter Gamble as CEO.
Yeah, well, there's plenty of criticism in the market when he took the CEO position at Seven West Media, but I don't think it was ever a long-term move. He's come in to that particular company, struggling media business, and really cut costs significantly, really restructured senior management and sort of groomed some future leaders of the company. And now with, it looks like if he does move into Seven Group Holdings, they're facing some sort of pressures within that business at the moment as well, because if you look at one of their big drivers, has to be their WestTrac business, which is a top 5 worldwide cat dealer. And if you have a look at sort of orders within that space at the moment, it's seen a significant slowdown. This is a lot to do with what we're seeing in the mining investment space at the moment. And if you look at, say, the equipment manufacturer orders for someone like Caterpillar, in the month of March, you know, they were down something like 25% year on year. Komatsu down sort of 28% year on year. So orders have dropped off significantly. So Don Voelte has a good track record of running, I suppose, a strong cost-cutting regime. So in a situation where WestTrac's facing these kinds of declines in orders, and the business cycle looks like it's sort of at low points at the moment, could come in and cut costs, of course. He's done a great job of streamlining that Seven West Media business, and we've seen the share price react very favourably over the past few months in terms of media stocks.
Okay.